Welcome to the deep dive. This is where we take those big, complex subjects, wade through all the source material, and really boil it down to what you actually need to know. No fluff, just the core stuff. We're aiming for those moments where it just clicks. And today, we're doing a deep dive into, well, an area of law that can seem pretty daunting at first, especially if you're looking at it for something like, the bar exam, partnerships. But stick with us. By the end of this, you won't just understand partnerships, you'll feel genuinely well-informed. Ready for those tricky questions? Our mission today, to really unravel the world of legal partnerships. Foundational stuff, actually. We're going to break down all the essentials right from square one. Think of it as your roadmap. We're leaning heavily on the revised Uniform Partnership Act of 1997, RUPA, you'll hear us call it. And RUPA isn't just theory, it's the basis for partnership law in most states. Crucially, it's what you'll likely see on the exam. So if you're thinking, partnerships, I know zero, where do I start? You're exactly where you need to be. We'll build this up step by step, make these dense legal ideas feel, well, approachable, understandable, maybe even interesting.
That's the plan, exactly. Look, our goal isn't just to read you definitions. Anyone can look those up. We want to give you the context, the why behind these rules.
Yeah.
Because that deeper understanding, that's what you need for critical thinking.
Yeah.
For those tricky exam hypos or, real-life practice later on. We want you to get an intuitive feel for how partnership law works. So you can connect the dots, spot the issues, kind of like developing a legal sixth sense for this stuff.
Okay, so let's dive in. The absolute foundation. When we say partnership, what are we actually talking about, legally speaking? RUPA, the Revised Uniform Partnership Act, it defines it as an association of two or more persons or entities to carry on a for-profit business as co-owners. Seems simple enough on the surface, right? But there are some really critical pieces tucked into that sentence. We should probably unpack those first.
Definitely. And that phrase, as co-owners, that's hugely important. It's way more than just, say, sharing office space or working on a project together. Co-ownership, legally, means sharing both the profits and the control. Now, it doesn't have to be perfectly equal shares of each, mind you. One partner might get more profit, another might handle more day-to-day stuff. But the core idea is that shared responsibility, that shared stake in the venture. And when RUPA says persons or entities, that's deliberately broad. It covers how businesses work today. It's not just two people shaking hands anymore. A person here can be an individual, sure, but it could also be a corporation, a trust, even another partnership, or an LLC. That broadness really shows how flexible partnerships can be.
So that RUPA definition association, two or more persons or entities, for-profit business as co-owners, that's the bedrock. Got it. Everything else we talk about today kind of builds on that. You absolutely need that definition locked down for the bar and just for understanding this whole area. Okay, now here's something that often trips people up. It's actually one of the most surprising things about partnerships. The standard for actually forming one. Surprisingly low. You might think you need like fancy documents, maybe estate filing.
Right, people assume there's got to be some formality, but the sources are clear. You don't actually need the specific intent to form something called a partnership. What you do need is the intent to carry on a for-profit business as co-owners. That's the key distinction.
So it's a common mistake then, thinking, oh, we never said let's be partners, so we aren't.
Exactly. That's not how it works. Two friends could, say, start selling handmade stuff online. They plan to split the profits. They both manage the website and shipping. Boom. They might have just formed a partnership legally, maybe without even realizing all the implications, all the duties and liabilities we'll get into.
Wow, okay. So actions definitely speak louder than words there.
Yeah.
Now, another critical point on formation, and this is classic bar exam territory, the statute of frauds. Generally speaking, you don't need a written agreement to form a partnership. A verbal agreement can be totally valid if you meet those co-owner criteria.
Informal is often okay to start.
But there's a huge but, a critical exception. If the partnership agreement by its own terms cannot be performed within 1 year from when it's made, then it must be in writing to be enforceable under the statute of frauds.
That's the one. So if you agree, say, let's partner on this specific project for the next 2 years, that agreement, it needs to be written down. That 1 year rule is vital to remember.
Okay, got it. Now, you mentioned profit sharing earlier.
Yes. And this is where things can get really tricky in practice. It's a major point of confusion. RUPA sets up a very strong presumption. If people are sharing the profits from a business, the law strongly presumes it is a partnership. The burden then shifts. It's up to them to prove it isn't a partnership, if they claim otherwise.
So those casual side hustles we talked about, if they start splitting profits.
Exactly. That's how they can accidentally create a legal partnership with all the personal liability that comes with it if they're not careful. Their actions, sharing profits, imply partnership. And it's crucial here to distinguish sharing profits from sharing gross returns. Our sources emphasize this. Sharing gross returns, that's like the total revenue before expenses, that does not create the partnership presumption.
Okay, so just splitting the top line number isn't enough.
Right. Profit sharing means splitting what's left after expenses, the net gain. That implies a deeper level of co-ownership, Shared risk, shared reward. Much stronger evidence of a partnership intent.
Makes sense. But this profit-sharing presumption, strong as it is, isn't absolute, right? There are exceptions.
Correct. There are specific situations where sharing profits doesn't automatically mean it's a partnership. And thankfully, there's a handy mnemonic for these. Drawing.
Drawing. Okay,
Yeah.
let's draw this out. These seem like prime bar exam fodder. So D is for debt payments.
Right.
R is for rent.
Yeah.
A for annuities or other retirement health benefits. W for wages or other compensation.
Got it.
N for interest or loan charges.
Okay.
And G for goodwill payments from selling a business.
Perfect. Those are the 6 big exceptions under drawing.
Could you maybe give a quick example for each just to make them really concrete?
Sure, let's run through them. For debt payments, imagine someone lends money to a startup. Instead of just a fixed interest rate, maybe the repayment includes a small percentage of the profits. That profit share is tied to paying back the debt, not being a co-owner. It's just financing.
Okay, makes sense. Like a bonus for the lender if the business does well. What about rent?
Rent. Think of a mall landlord. They might charge a base rent plus, say, 1% of the store's profits from that location. The landlord isn't suddenly a partner in the retail business, right? It's just a variable rent structure. Still a landlord-tenant relationship.
Got it. And annuities.
Annuities or retirement benefits. Maybe a founder sells their share, but the deal includes ongoing payments based on future profits, like a deferred compensation or retirement plan. It relates to a past role, not current co-ownership.
Right. Wages. That seems common.
Wages, exactly. Like a top salesperson getting a salary plus a commission based on the company's overall profits. Their pay depends on success, but they're an employee, not a co-owner with control. Classic employment scenario.
Interest. Seems similar to debt.
Interest, very similar. A bank loan might have an interest rate partly tied to the borrower's profitability. The bank isn't becoming a partner, it's just a loan with a variable interest feature. Still a lender.
And finally, goodwill.
Goodwill. If you sell your business and part of the price is paid out as a share of future profits for, say, 3 years, that's payment for the business you already sold, including its reputation, its goodwill, not an ongoing partnership interest.
Okay, that drawing breakdown is super helpful.
And the why behind these exceptions is key. They cover common business deals where profit sharing happens, but nobody intends to be actual co-owners sharing control. The law respects that intent. It avoids forcing partnership status with all its duties and liabilities onto people in purely transactional roles.
That makes perfect sense. And it really highlights something you mentioned earlier, the importance of a written agreement. Even though it's not required for formation in most cases,
Yeah.
if you do have one, our UPA says that agreement will govern the partnership.
Absolutely critical point. That agreement is your chance to customize. To override the default RUPay rules we're discussing, you can define precisely how profits and losses are shared, who has what management authority, how decisions are made, what happens if someone leaves.
So it's not just about avoiding fights later, it's actually about structuring the business the way you want it.
Exactly. It's strategic control. You move from the default, off-the-shelf RUPA rules to a bespoke framework designed for your specific situation. Highly recommended, even if not legally required at the outset.
Okay, this next concept, this is where it gets really interesting. It shows how the law steps in to protect people who might be misled. Imagine someone isn't actually a partner. Maybe no formal partnership even exists. But under certain circumstances, they can be treated as if they were a partner. We call this a purported partner, or partner by estoppel. It's all about fairness to third parties who reasonably rely on appearances.
It's a powerful doctrine. It essentially says, if you look like a duck, walk like a duck, and quack like a duck, you might be held liable like a duck, even if you're not technically a duck on paper.
Okay, so how does someone become a purported partner? What are the requirements? Our sources list 4 specific things. First, there has to be a representation. This could be spoken, written, or even just implied by how someone acts representing that they are a partner.
Right. Holding themselves out or letting someone else hold them out.
Second, The purported partner has to either make or consent to that representation. They have to be involved somehow, or at least aware and not correcting it. You can't usually be made liable just because someone else lied about you without your knowledge.
Consent is key there. Active or passive.
Third, a third party has to reasonably rely on that representation. It's not about gullibility, it's about whether a reasonable person in that third party's shoes would believe the representation.
Context matters. Was the reliance reasonable under the circumstances?
And fourth, the third party has to suffer damages because they relied on that representation. There needs to be actual harm linked to the reliance.
That's the core of estoppel detrimental reliance. You believe the representation, acted on it, and got hurt as a result.
So the why here is really about protecting innocent outsiders.
Exactly. It's a shield for third parties. It stops people from benefiting from a misrepresentation or allowing one to continue and then saying, oh, but technically I wasn't really a partner. It enforces accountability based on actions and appearances. And there's a neat little nuance in the sources, too. If person A misrepresents person B as their partner and person B consents or knows about it, person B, the purported partner, can actually become an agent of person A, the one making the representation.
Oh, interesting. So the liability link might be directly to the person doing the misrepresenting.
Potentially, yes. It highlights those agency principles again. If I tell a supplier, my friend Sarah is my partner, and she knows and allows it, and the supplier gives us credit based on that, Sarah might be liable to the supplier effectively as my agent in that transaction, even if no true partnership exists between Sarah and me. It focuses liability on who created the misleading impression. Now, something that often causes a bit of head scratching is the dual nature of a partnership under RUPA. Our source is clear. A partnership is a separate legal entity. Think of it like its own legal person in many ways. It can own property in its own name, the partnership's name, not the partner's. That's huge for clear ownership. And it can sue and be sued in its own name. The partnership itself can be the plaintiff or defendant in court, separate from the individual partners. Operationally, it's distinct.
Okay, so it acts like its own thing. It owns stuff. It can go to court. But, and this feels like a really big but, right after saying it's a separate entity, the source hits us with the crucial caveat. Despite being a separate entity, its partners are personally liable for the partnership's debts and obligations.
Bingo. That's the fundamental trade-off. And it's probably the single biggest difference between a general partnership and, say, a corporation or an LLC.
So explain that. What does personally liable really mean in this context?
It means if the partnership owes money maybe to a supplier, a lender, or someone who won a lawsuit against it, and the partnership's own assets aren't enough to cover that debt, then the creditors can come after the partner's personal assets, their houses, their savings accounts, their cars, whatever they own personally. It's not limited to the business assets.
Wow. Okay. So the entity status gives it operational independence, but it doesn't shield the partners personally.
Precisely. And connecting back to the why, RUPA grants entity status for convenience, easier to own property, make contracts, handle lawsuits as a unit, but it deliberately preserves that traditional partnership characteristic of shared risk and ultimate personal accountability. It reflects the historical nature of partnership where partners stood behind the business fully. So you get the operational benefits of an entity, but you retain the personal financial exposure. Understanding that dual nature, separate entity, but personal liability is absolutely key.
Okay, so we know what a partnership is and how it forms and about that personal liability. Let's move into how they actually operate, the ongoing responsibilities. We said a partner is basically an agent of the partnership. They can bind it to contracts. But that power comes with serious responsibility, right, towards the partnership and the other partners.
Absolutely. Huge responsibility. These are called fiduciary duties. They're the legal and ethical obligations partners owe each other and the partnership itself. Think of them as the required standard of conduct. RUPA lays out three core ones: the duty of loyalty, the duty of care, and also an overarching obligation of good faith and fair dealing in everything partners do related to the partnership.
Let's dig into the duty of loyalty first. That sounds really fundamental. What does it actually require a partner to do or maybe not do?
It's all about putting the partnership's interests ahead of your own personal interests in certain situations. RUPA specifically says a partner must not: 1, compete with the partnership business. If your partner's in a coffee shop, you generally can't open your own competing coffee shop next door. Pretty straightforward.
Okay.
2, advance an interest adverse to the partnership. You can't actively work against the partnership's goals or benefit from its misfortune.
Makes sense.
And 3, usurp a partnership opportunity. If a business opportunity arises that rightfully belongs to the partnership, meaning it's in the partnership's line of business, a partner can't secretly take it for themselves. They have to offer it to the partnership first.
Right, you can't steal the partnership's potential business. Now, can partners change these duties? Like write them out of an agreement?
Ah, good question. And the rules on modifying these duties are critical, often tested. For the duty of loyalty, you cannot completely eliminate it. RUPA sees it as too fundamental to the trust required in a partnership.
Okay, so it's non-waivable at its core.
Right. However, the partnership agreement can identify specific types of activities that, if reasonable, are defined as not violating the duty. So you can carve out exceptions or clarify boundaries in advance.
Like maybe allowing a partner to continue a pre-existing, slightly related business.
Exactly, if it's clearly defined in the agreement. And importantly, the agreement can create a safe harbor. This means if a partner has a potential conflict or wants to take an opportunity that might arguably belong to the partnership, they can protect themselves
Oh,
by fully disclosing all the material facts to the other partners and getting their informed consent.
transparency and approval. That's the safe harbor.
Precisely. Full disclosure plus partner approval, generally no breach of loyalty. It encourages openness.
Got it. What about the second duty, the duty of care? How does that differ from loyalty?
If loyalty is about whose interests you prioritize, care is about how you act when conducting partnership business. It sets a standard for competence and diligence. Under RUPA, a partner has to refrain from 1. Grossly negligent or reckless conduct, notice the word grossly, 2. Intentional misconduct, and 3. Knowingly violating the law.
So it's not just about simple mistakes. Grossly negligent sounds like a pretty high bar.
It is. It's significantly more than ordinary negligence or simple carelessness. Ordinary business mistakes or bad judgments, even if they lose the partnership money, generally don't breach the duty of care.
Can you give an analogy maybe? Like, what's the difference between simple negligence and gross negligence?
Sure. Think about driving. Simple negligence might be briefly looking away from the road and causing a minor fender bender. Unfortunate, but maybe just careless. Gross negligence. That's more like deciding to drive blindfolded down the highway or speeding through a residential area at 100-mile-per-hour. It's a conscious disregard for safety or recklessness that shows an extreme lack of care.
Okay, that clarifies the standard. It's a much bigger failure of responsibility. And can this duty be modified in the agreement?
Similar to loyalty, you cannot unreasonably reduce the duty of care. The agreement can perhaps clarify standards, but it can't lower the bar so much that it essentially excuses reckless or intentional harm. That high threshold gross negligence is there to protect partners from liability for honest errors, while still holding them accountable for truly bad behavior.
Right. It allows for business risk-taking without constant fear of lawsuits for every decision that doesn't pan out perfectly.
Exactly. Now, it's also important to know when these duties apply. Our source mentions they generally cover the whole life cycle. Formation, operation, even during dissociation and winding up. But there's a key point about the duty not to compete, part of loyalty, that specific duty. It continues even after a partner dissociates, all the way until the partnership's winding up is totally complete.
Wait, so even after you leave the partnership, you still can't compete with it until it's fully shut down? That seems potentially long.
It can be. And it's a common trap. Why does it last so long? Think about winding up. The partnership is still trying to sell its assets, maybe fulfill old contracts, collect debts. If a recently departed partner could immediately set up shop next door and start poaching clients or undermining asset sales, it could seriously harm the partnership's ability to wind up effectively and pay off its debts.
Okay. So it's about protecting the value of the business during that final liquidation phase.
Exactly. Protecting the partnership's remaining interests until the doors are finally closed.
Okay, duties make sense. Let's shift to the money side. Profits and losses. How does that work by default if the partners don't agree otherwise?
The default RUPA rule is surprisingly simple and often counterintuitive. Profits are shared equally among the partners, and losses, they follow profits, so losses are also shared equally.
Equally, regardless of who put in more capital or who does more work.
By default, yes. One partner could contribute 90% of the capital and do 10% of the work, and another partner the reverse. But under the default rule, they split profits and losses 50-50.
Wow. Okay, that seems like something you definitely want to address in a partnership agreement.
Absolutely. It's one of the first things most people customize. Now, if the agreement only specifies how profits are shared, say 70-30, but it's silent on losses.
Then losses follow the profit split, so 70-30 for losses too.
Correct. Losses follow profits unless the agreement explicitly says otherwise.
Got it. And partners have individual accounts within the partnership, right?
Yes, each partner typically has a partnership account. Think of it like their individual financial stake tracker within the partnership. It starts with their capital contributions, increases with their share of profits, and decreases with distributions they take out or their share of losses and liabilities. It's basically their running equity balance.
And can a partner just demand their share of the profits whenever they want?
Generally, no. A partner usually cannot demand a distribution just because the partnership made a profit and their account was credited. Decisions about when and how much to distribute are typically management decisions, often requiring majority or even unanimous consent depending on the agreement or the default rules we'll discuss. The account credit is just an accounting reality, not an immediate right to cash. Beyond the account itself, we talk about a partner's partnership interest. This is a slightly broader concept. It represents the partner's bundle of economic rights, primarily the right to share in profits and losses, and the right to receive distributions when they are made. It's what they own economically in the partnership.
And can a partner sell or transfer that interest to someone else, like selling stock?
They can transfer all or part of their economic partnership interest, yes, unless there's a restriction in the agreement that the transferee knows about. But, and this is a huge but, compared to stocks, transferring the interest does not automatically make the original partner leave, dissociate, or end the partnership, dissolve.
So the person who sold their interest is still technically a partner?
Yes. The transfer partner, the one who transferred the interest according to our sources, retains all other rights and duties of a partner. They still have fiduciary duties. They still have potential liability for partnership debts.
But they don't get the profits anymore.
Yeah.
Those go to the person they transfer the interest to, the transferee.
Exactly. The economic benefit, the right to distributions, flows to the transferee, but the original partner keeps the status, the rights, like management, if they had them, and importantly, the duties and liabilities.
That sounds complicated. What rights does the transferee actually get then? The person who received the interest?
Very limited rights. The transferee gets the right to receive distributions, sure. They also get the right, under certain circumstances, to ask a court to dissolve the partnership. And upon dissolution, they have a right to an accounting. But crucially, they get no right to participate in management, no right to conduct partnership business, no right to access partnership records beyond what's needed for distributions dissolution, and no right to demand other information.
So they're basically just a passive recipient of money, a silent investor with almost no control or insight.
Pretty much. That's the default RUPA position. It protects the existing partners from having an unwanted new partner forced upon them in terms of management, while still allowing for some financial liquidity.
And one last point on this interest. It's considered personal property, right?
Yeah.
Even if the partnership owns tons of real estate.
Correct. Your interest in the partnership is personal property, regardless of what assets the partnership owns. That simplifies things like transferring the interest or dealing with it in wills and estates. Building on that entity concept, let's be clear about property ownership. Property acquired by the partnership belongs to the partnership itself as an entity, not to the individual partners jointly.
So partners don't own like a 25% share of the office building. The partnership owns 100% of it.
Exactly. The entity owns the asset. This is important for liability partnership assets are primarily available for partnership debts. It also simplifies things. If a partner leaves, they don't take a chunk of the building with them, they get bought out of their interest. And RUPA provides helpful presumptions to figure out who owns what if it's unclear. Property is presumed to be partnership property if it was bought with partnership funds or financed using the partnership's credit. Basically, if the partnership paid for it or borrowed for it, it's presumed to be the partnership's.
Okay, that makes sense. Follow the money. But what if it's genuinely ambiguous? Maybe a partner used personal funds for the down payment, but the partnership made all the mortgage payments.
Right. In those ambiguous cases, courts look at several factors. How is the property used, primarily for the business or personally? How is it treated for taxes? Does the partnership claim depreciation?
Yeah.
Who pays for insurance, maintenance, improvements? The more factors point towards partnership use and financial responsibility, the more likely it is to be deemed partnership property, even if the title is murky or initially funded personally. It's about the substance of the ownership and use.
All right, so we've got duties, money, property. Now, who's actually in charge? Who makes the decisions in a partnership? What's the default rule for management rights?
The default RUPA rule is, again, surprisingly simple and sometimes problematic in practice. Each partner has equal rights in the management and conduct of the partnership business.
Equal rights. just like equal profit sharing by default, regardless of experience or contribution.
Exactly. One partner, one vote, essentially. Unless the partnership agreement changes that, which, again, many do, setting up managing partners or different voting weights.
Okay, but surely not every single decision requires a full partnership vote. That would grind things to a halt.
Correct. RUPA and often partnership agreements create tiers of partner approval requirements depending on the significance of the decision. This is super